Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
Hello and welcome to Wealth is in the Details with Peter Raskin from Raskin Planning Group. Good morning, Peter. How are you doing?
I'm doing great, Eric. It feels like spring is finally here in New England, where it's just perfect
That
weather.
is awesome. I've seen so many people out and about just walking, riding bicycles, walking dogs, just taking advantage of nice warm weather, fresh air. Again, we're halfway through, almost halfway through 2021, and I think people are really feeling more comfortable, just being outside and being around other people.
Oh, definitely. I took a 2-hour walk in the woods yesterday, and I didn't see a lot of people, but when I did see people, there was that feeling of freedom, free at last.
Smiling and happy. Yeah, exactly.
Yeah,
right.
I could see the smiles.
Yeah, absolutely. And, and I know that you and I live in different parts of the country. And actually, for the audience, if you don't know, Peter and I have never met in person. But I really feel like I've gotten to know you, pretty well through these last couple of years. You've taught me a ton. And my sense personally is that you and I have way more in common than we don't have in common, right? Especially you're super optimistic. And you're a people person, and you have a lot of interest in people. That's why, obviously, you do this podcast, is to educate people. And I'm really interested because today's topic is the 5 biggest financial planning mistakes during COVID. You sent me that note saying that's what we're going to talk about. But that sounds kind of negative. What's up with that?
Yeah. Well, thanks for calling me out on that topic.
No problem. That's what I'm here for.
Yeah. So my objective is to use these mistakes that I've seen and as teaching tools to really help our listeners just enhance their chances of success. It's my goal today is to turn those negative mistake feelings into positive outcomes, and really to help people meet their objectives. Be good stewards of wealth, and to help families and communities. And so, think about this topic as a hook that hopefully can get our listeners' attentions.
Mm-hmm. Yep, I hope so.
Yeah, I hope so too. So I want to stress that while these mistakes have certainly happened over the last 14 or 15 months, I really think of them as evergreen mistakes. They just keep on happening. They just we're all human beings. So this is even after this podcast, and even after people listen, they're going to still have the same feelings and concerns at different times. So I think, while it sounds a bit negative, think about it as just overcoming human behavior. That's our goal today.
Got it. So pandemic or no pandemic, these are mistakes that people are making. Pre-pandemic, post-pandemic, most likely people will make them. And that sounds pretty reasonable. But I'm going to ask you, let's stay on the bright side if we can.
That's right. Yeah.
Right? Let's give it a shot. So what's the first mistake, Peter?
Well, this is, I've talked about this in the past on podcasts. So the biggest mistake I see is that people listen to prognosticators. They who tell a really good story that sounds so logical that, of course, it's just going to play out exactly as the prognosticator has said it will. Mm-hmm. So, just as an aside, we're all humans, and we are connection machines. This is about human behavior. And one thing we're very successful at doing is recognizing patterns. And you've probably heard the phrase, correlation does not imply causation. So what that really means, just because two trends seem to be happening in tandem or at the same time, just doesn't prove that they're meaningfully related to one another, that there's a cause and effect of things happening.
Gotcha. That sounds kind of like the foundation of a conspiracy theory.
Yeah, I think it really is. In a lot of ways. So this is just human behavior. It's not, no one's smarter or dumber because of it. It's just we make connections. And let me just give you some examples of that. So one of the things that is very clear to me is that it's really, really hard to predict the direction of things, whether it's interest rates, inflation, how deficits are going to affect the markets, how a winning political party will affect the economy or the markets. So, we just shouldn't try to guess, if and when taxes are going to go up or down. It's just too hard. We're not right enough times. So, over these recent months and years, the consensus has just been wrong on most of these fronts. So just around interest rates, we've been talking about interest rates going up since 2009, 2008. They can't get any lower. They're going to be going up. And over the last 18 months, interest rates have fluctuated pretty dramatically, although as a percent they've increased a lot, but as far as the interest rates are still very, very low. When COVID pushed us into a recession back in February and March and April of last year, interest rates went down even further than they were. And since then, they've really bounced back up to where we were about 15, 16 months ago. So we can guess, but we just don't really know the direction of interest rates.
Yeah.
And my feeling is, if you don't know, you're best not to predict. Another thing that people have been predicting is inflation. And, we just haven't seen a lot of inflation for well over a decade. So, interest rates have picked up recently, but we don't know if that's going to translate into sustained inflation or not. And that's really the issue, is sustained inflation at a higher level. Another example are deficits. The Trump tax cuts, one argument goes, is that they dramatically increased the deficits and because spending didn't go down. And so, but that fiscal stimulation, which we saw then, the tax cuts are stimulating the economy. The relief that we've seen in the recent past over the last 12 months has led to additional stimulation. So even though we've seen really significant increases in deficits, the economy continues to recover, and interest rates are, relatively speaking, still really low. So we just can't, we can't do anything with that information. It's neither good nor bad that deficits have increased recently. Another just example is, we've had Democrats and Republicans in charge during severe recessions and stock market corrections, and we've had recoveries in both, no matter who's in charge, who's our leadership. So again, predictions don't really tell us what's really going to happen. And now we're talking about tax rate increases. Some of our clients are concerned that we're going to see tax rate increases, and that could very well be. The Democrats want to increase taxes on the very wealthy, and the Republicans are saying no way. But we have no idea how that's going to play out. There's too many options available. We just can't predict when and how that's going to actually play out. So my feeling is, listen to the news, listen to these people that are predicting what's going to happen, but don't make dramatic changes based on what might take place.
Yeah. I mean, and you said it on this podcast before, trying to predict the future just doesn't work. But we do want to plan. We do want to have some sort of control, right? We want to do something, right? We don't want to just sit back and do nothing. So what are we supposed to do?
Let's focus on the things that we can control, and not focus on the markets or the economy. So instead of worrying about the direction of interest rates or taxes, think about long-term objectives. What do you want from your investments? Do you want it to grow? Is that the most important issue, or do you need current income? Are you concerned about stability? And then when do you want these things? Do you want growth now? Do you want income later? Are you're looking for stability now? You're looking for stability later. So, if you're investing in stocks and bonds, remember you're buying assets that are going to fluctuate in value every day. And sometimes the fluctuations can be dramatic. So if you are buying stocks and bonds, and most of our clients are, frankly, just accept that as a reality, that they're going to move. There's going to be movement to the value of those assets daily. And focus on the reality that really what you're doing is you're buying companies that produce goods and services. And despite interest rates, despite inflation, tax changes, regulations, politics, deficits, recessions, consumers are going to purchase those products and services, and the companies are likely going to have earnings and profits. So over time, the economy is likely to grow, and so will many of the companies that you invest in. Not all, but many. And so that's the key, is just think about what you're actually doing. And these things, the noise that's happening on a daily or weekly or monthly basis don't necessarily affect the true intrinsic value of that asset. It may have fluctuation in value, but Apple is still selling iPhones. They've been selling iPhones throughout this whole 15 months that we've been through. Yep. And so have lots of other companies been selling their products.
Yeah. Well, my family got new iPhones during the pandemic. I mean, that was one thing that it was just our phones were old, and we've been with Apple for quite a while, and so we ended up doing that. I mean, that's just it. There are things that you need in your life to operate your business, to operate just your life in general. And those are things that they're not going to go away, toilet paper being one, right? And everybody's going to need either toilet paper or a bidet. So those companies are still going to make money through a pandemic, after a pandemic, pre-pandemic, all that stuff. So exactly. I'm sure there are other mistakes that you've seen. What are some other mistakes?
Yeah, so mistake number 2 is probably the biggest. Let me back up. So let's edit that.
Sure, edit.
Probably the biggest mistake I've seen is when investors decide they want less or more risk in their portfolio due to the way they feel about the economy or politics or about the world in general. They're just feeling angst, and that's not unreasonable. That's normal and natural during times that are difficult. But making investment decisions based on how you feel of what you're reading is really not really positive. It doesn't help you.
Isn't that like timing the market, Peter?
Exactly.
Yeah.
To me it is. So we had lots of conversations with clients last March and April and May, and people were scared and frustrated and concerned on so many levels. And many people were suffering. So it's not to discount that. And they felt like they needed to do something. They needed to take action. And they really were anxious and wanted to do something to preserve their capital. And when clients are coming to us with those kinds of questions, I do my best to talk about how they're feeling, why they're feeling that way, but then to turn the conversation to their true objectives. So what's changed about your objectives? Has your income, have your expenses changed? If the answer is yes, well, maybe we need to make changes due to the reality of that situation. But if the answer is no, then making a change, it feels like you're taking action, but may not necessarily help. So reducing risk was a common refrain last March and April and May of last year. And a lot of clients wanted to reduce their exposure to stocks and move into cash or bonds. And by doing that, this was after the market had corrected by about a third. The stock market went down by over 30% in February and March and April of last year, quickly rebounded. So if people made those changes in March and April and May before the rebound, they were basically
Yeah.
selling low, moving into bonds, which, because we were then into a recession, interest rates came down, and basically you're selling stocks low and you're buying bonds high.
Yeah.
And now, 6 to 12 months later, we're having similar conversations that clients want to move into more risky assets. They want to sell their bonds and buy more stocks. Now, stocks are now higher. Bonds are actually lower because interest rates have scooted up a bit.
Yeah.
There's an inverse relationship between interest rates and bond values. When interest rates go up, bond values go down. When interest rates go down, bond values tend to go up. So basically, people have done the wrong thing, completely the wrong thing.
Yeah.
But by moving that way.
Yeah. Well, it sounds like, again, you started off this podcast saying this is kind of a reoccurring theme. These mistakes are made, whether it's pandemic or not pandemic. And you said it before, you focus on the plan. You guys work so hard putting a plan together, which is a long-term plan. You should be focused on that and not the emotion in the moment.
That's what we try to tell our clients all the time.
Yeah.
And hopefully our listeners will keep that in mind when we experience the next volatile moment in the stock market, the bond market, the political political experience we're in, whatever it is. Think about the long term.
Yeah.
Another mistake I've seen is holding on to specific assets or funds because it's done really well. Not because it's appropriate to hold, but just because it's had such a run up, or not selling a fund because it's done poorly and they want it to rebound.
Yeah, I'm sorry. Right when you said that, I just pictured somebody holding on to an anchor as they're in a quicksand, right? It was like, but this anchor's valuable. I don't care if the anchor's made of gold. If it's weighing you down, pulling you under, I don't know. That flashed in my mind. It's a hard spot to be in when you think something's going to come back and it's not gonna, maybe.
Well, it just because a stock or a fund continues to go up in value doesn't mean it won't continue to go up, nor does it mean that it won't go down.
Yeah.
And just because a stock is going down in value doesn't mean that it's not going to go up eventually, but it doesn't mean that it won't continue to go down in value. So,
yeah.
It's just the way it is. So the mistake here is that clients hold on to something. They ride it up and up and up, and guess what? It eventually will come down. For the last 10 years or so, even longer, large company growth stocks, especially those in the technology sector, have given investors incredible returns. You may have heard of the FANG stocks, such as their Facebook, Apple, Amazon, Netflix, and Google, which is now called Alphabet. But these stocks have just done incredibly well. And frankly, if you didn't hold those stocks or stocks like them over the last 10 years, your returns might have been not quite as good. They've been fabulous stocks to own. And I'm not recommending that investors sell these stocks. What I'm recommending is periodically rebalancing. Because as these stocks increase in value, they just become too large an allocation in a portfolio. And so remember what I said before, we all want to buy low and sell high. And if you reduce your holding as the stock continue to do very well, then you're basically selling high and higher and reallocating into other stocks or bonds where they may not have gone up quite as much at that point in time, but they will also have their day.
Mm-hmm.
So it's really important to be thinking about managing that risk. And the stock market, has a history of tons of stories where we have a fabulous company with a unique technology or business model that does well for a long period of time and then doesn't. I think of Kodak as just that great example. Kodak, 60s and 70s was an incredible company selling film.
Mm-hmm.
Well, we don't use film anymore. At least the consumer doesn't.
Yeah.
And so that technology's out. That
Yeah.
company doesn't really exist. And another great example is General Electric, which was just one of those fantastic stocks for decades. And now it isn't. Doesn't mean it's not still a good company. It just has done very poorly in recent years.
Yeah.
So again, back to that focus. Focus on your objectives, whether it's growth or income, and manage the risk of the security. Rebalance as time goes on, and you'll have good success managing it that way.
The problem with many investors have with their stocks or funds, the run up in value is that at some point they need to realize capital gains. You've talked about that before, and I don't understand it exactly still. I mean, I'm learning from you. People don't want to pay taxes, so they hold on to it because they don't want to have to pay the capital gains, right?
Yeah. This is another big mistake. You've heard me say this before, Eric, and I can't say it enough. Don't let the tax tail wag the dog.
Mm-hmm.
And that's especially true when we've got highly appreciated assets like the FANG stocks, or like real estate, or anything that's appreciated in value that's done super well. We don't want to hold on to that asset for the sake of holding on and not wanting to pay tax.
Mm-hmm.
And just here are some considerations. Publicly traded stocks, they're not a family heirloom or a collectible, and so don't treat it that way.
Yeah.
Keep your emotion out of it. Focus on the reason for owning the stock and always revisit that reason. What's the risk and what's the potential reward of owning that stock or mutual fund? Either way, it doesn't matter. What's the risk and the potential reward? By deferring the sale, you're basically deferring the tax that you'll owe. When you own an appreciated asset, there's a lien on that security or that asset, and that's the tax that you eventually will owe. And the capital gain tax is going to be paid at some point in the future. If it's a capital gain, if it's a long-term capital gain, that tax rate is right now it's at 15 and 20% federal. There might be additional Medicare tax or estate tax. And capital gains taxes could go up in the future, but we don't really know. Think about this, that the tax that would be due by reducing or selling some of that security could be that 15 or 20% could be gone in a day because of stock market volatility.
Yeah.
So it's just, while it is important, we don't want to realize gains, and then pay tax when we don't have to. It shouldn't be the driving force. Think again about what your goal is. And then approach it from a management perspective. How to manage those tax costs over years. Spreading it out over a few years might help. Use losses in other securities to offset the gains. Donate the stock or the mutual fund to a charity or to a donor advised fund, or to a charitable trust that where you can retain some income. Maybe gift your stock to a grown-up child that might be in a very low tax bracket, and you could even avoid all capital gains tax. So there's ways to manage the tax hit, but always focus on the goal. That's the key.
Yeah, absolutely. All right, what is the next mistake, or I guess we could say educational opportunity?
Yeah, this won't really come as a surprise to our listeners. But the biggest mistake I see is not revisiting your plan on a regular basis. And what I've seen so many times is that we tend to focus on the urgent, the stuff that's easy to take care of, the more pleasurable things, and we procrastinate about doing those really important things that are just often harder and time consuming. So when life is uneventful and going along as we expect, this isn't a problem, not revisiting the plan. But that's not the real world, is it?
Not at all.
Yeah. We just know something's going to come up.
Yeah.
And, so last year was just a perfect example of an unexpected situation. Mm-hmm. And frankly, most of our clients were really unscathed by COVID financially. They most of them just were in a lucky situation where they weren't affected financially. But we did have some clients who retired unexpectedly. We did have clients that had unexpected expenses, and frankly, markets were really scary for a whole bunch of months.
Yeah.
So those clients that kept up with their planning found the decision making around these issues just so much easier and less time consuming. Mm-hmm. It was because we had revisited it recently.
Yeah.
And they knew that they were going to be okay. And so there was less angst, and they worked through the market volatility, I think, with less anxiety. Mm-hmm. They weren't rushed to update, their estate plans. They just felt ready for this crisis, and frankly, they'll be ready for the next crisis because we know it will take place.
Yeah.
So there's really a great sense of relief to revise and revisit and do the detailed planning work that needs to happen, at least annually. That's just my feeling. So I really do think that it helps people sleep at night and helps you get through tough times when the unexpected happens, and it always does.
Yeah, absolutely. And I've worked with a lot of financial advisors through the years in different capacities, and the ones that are working regularly with their clients, right? Because when something comes up, like when 2008 and 2009 hit and there was, just a lot of unrest, the people that really felt the most nervous were the ones that were having to call their advisor who they hadn't spoken to in a few years to see what was going on. The people that are working with someone like you, Peter, that, you believe in regular holistic planning, they know they talk to you on a regular basis. They know that you're accessible. They know that you got your finger on the pulse of things. Even when something comes up that nobody could plan for, like a pandemic, it goes back to that plan, that regular holistic planning. And I think you said it best just a moment ago. It really allows everybody to sleep better at night.
Yeah, I really do believe that. If you go to the raskinplanning.com homepage, our website, I say it really clearly. I talk about this, that wealth is a journey. Be prepared.
Yeah.
And we help the business owner and the families plan for wealth's journey with clarity, diligence, and confidence. And that's really what we want to do. And so I'm hopeful that this discussion around these 5 mistakes that we've seen recently, most in the last 12, 15 months, and we've seen for decades. And I hope that this helps listeners avoid some of the problems that we just will face going forward, because there's going to be another crisis. We don't know what it looks like, but we know it's there. And right. So I think the planning really does help people sleep better.
Yeah. Whether it's Godzilla or alien invasion, we don't know what's coming next, but
right.
We know that the plan will be there, right? So anyway, Peter,
well, that's the optimistic part of you and I.
That's right. That's exactly it. Well, I appreciate this time. And like I said, I have been blessed by being on this journey with you for the past couple of years with this podcast. I've learned a ton, and I continue to hear the same thing from you in a slight theme, which is it's the plan. It's the planning. Let's plan for the future, not plan for this next month. Let's not plan for this next 6 months or reflect on the last 6 months. Let's look at what you really want to accomplish. And I love that. I love that message. And I think that that's something that all of us need a little bit of help with. And so again, Peter, I'm just going to ask you one more time. What's the contact information if they want to get a hold of you, whether it's through the website, email, whatever, to have this conversation? Because I know there are listeners right now that aren't working with an advisor, or they're working with an advisor that I spoke about earlier that they haven't spoken to in a few years. They probably need to revisit a plan. How can they get a hold of you if they want to just have that conversation?
Yeah, so I think my recommendation is to go to the website, raskinplanning.com, and reach out to us through that.
Yeah, absolutely. Again, Peter, thank you so much for your time today. And of course, our last thank you always goes to you, the listener. Thank you so much for tuning in and listening to the Wealth is in the Details podcast with Peter Raskin. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Peter comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks so much for listening today. For everyone at Raskin Planning Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corporation, a broker, dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln affiliates and other fine companies. Raskin Planning Group is not an affiliate of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.